So good afternoon. Uh, Today I'll be doing a trade review on. I think this was. I'm not so sure when was this trade, but I'll be doing a trade review on a trade on shorts that I took on a regular trading hour session. And I think this was a really simple trade. This trade had literally no drawdown. So what that means is the trade didn't go against me. I did not at any point in the trade experience any negative on the trade. So it was just from the moment I entered the trade, it was just straight up profits till I exited the trade. And so yeah, so I'll be teaching you. I'll be focusing on the logic that I was using on this trade and my thought process and yeah. So I hope you do find this insightful and you learn a lot from this and grab as much knowledge as you can away from this. That's what I just hope you guys get. So let's get to it. So this is obviously a regular trading hour session trade. We have the first presented fair value gap set in place. That's the blue rectangle shaded area. So we have that put in place. We have this displacement right here. Okay, before we get to the displacement, I wanted to talk about the orange shaded area, the large rectangle that I see there. So that's a 3-minute time frame, a bullish fair value gap. So it's a buy side imbalance, sell side inefficiency. And so obviously my bias on the day was to see low prices. And so when we have things like bullish fair value gaps on a market that's predisposed to go to offer sell side, to offer low prices, those buy side imbalance, sell side inefficiencies, those bullish fair value gaps, they should inverse their roles. They should inverse their original characteristics. So this was a bullish fair value gap. So reasonably you would expect it to support, to act as some sort of lever of support. But in a case of a market that's predisposed to offer low prices, that changes. That whole changes. That whole concept changes. And so now instead of it acting as support, you would expect price to cross over it, go below it, close below it, and act as an inverse. Get up into it and reject off it. And so that's exactly what was going on there. That's what happened. So when price gravitated up higher from here, gone up into that inversion fair value gap, that's price rejecting offer. That's the logic that's put in place. Do you understand that? And then when it gravitated all the way down again, you see that strong extrapolated displacement. That again just confirms, and it's kind of a feedback to me that it wants to go lower. It's very weak, it's very heavy, and so that displacement, that it's indicative of weakness. But if you can look to your left hand side, what I want to focus on here is when we gravitated up higher on this energetic price move up here, before we had that put in place, so before this candle, if you can look to your left hand side, we have this down close candle. That down close candle is what we call a breaker. It's a breaker block, so when price gravitates lower in that displacement lower, this is kind of an order block, but in the way price would use it is it would reject off it. And so when price had gone down to the first presented fair value gap, the blue shaded area, and rejected off its consequent encroachment, algorithmically gone up into that order block, I'm literally shorting it right there. So as it goes up into that order block, I'm shorting it. I'm shorting 2 contracts. And so that's me positioning into the trade. I shorted like 6 contracts on the trade. So that was the whole logic of the entry. And so, yeah. And now I've entered the trade and it's gone down and I'm in profit, significant profits. It's taken out mine is outside liquidity, and I've taken out 2 contracts already. So I've taken out partials, 2 contracts, and my target profit is all the way down there. And so I do want to emphasize again on the significance of taking partials on a trade. Because what partials do is they set you at ease. You don't need to worry about price reversing on you, experiencing drawdown. Because even if it does, you've taken out something, you've squeezed the trade as much as you can. And at this point, you really don't care whether the trade goes against you or not, because you've taken out profits, you've covered cost, and you've trailed your stop loss to break even. And so now you can manage the trade at ease, at comfort. And so this is the regular trading hour session, right? So this gap right here, you don't really see it on the electronic trading hours. So this is a opening range. This is what we call a opening range gap, consequent encroachment. Opening range gap. So this was from the settlement price of Thursday's trading, the 1614. So from the previous settlement prices close to the next candle's open, which is the regular trading hour open, which is at 9:30 a.m. Eastern Standard Time. And so that separation, that's what we call an opening range gap. And so what we know is there's a 70% likelihood that price is going to trade down to the halfway point of that gap, to the midpoint of that gap. So if you can get your Fibonacci tracement from, let's get this thing straight. Let's get one thing straight. This is a premium opening gap. So it's simply based on logic that price has opened up way higher than where it closed, than the previous settlement price, which was 1614, right? 1614 p.m. So it becomes, algorithmically, we would classify it as a premium opening. So price is at a premium from the moment it opens up. It's expensive. And so it's reasonable to expect price to offer low prices and gravitate lower to the midpoint of that gap. And so that's kind of what I'm doing right here. I'm annotating my fib from the regular trading hours previous settlement to its opening price. And so that's the 0.5, that's the 30% level, that's the midpoint. And so price should try to gravitate to those lows. And so that's one of my targets, and that's where I plan to take partials on. And so, yeah. And so I do end up taking partials right there. So that's outside liquidity, those relative lows. That's the opening range gap, consequent encroachment. And so I've just taken out partials there, squeezing the trade as much as I can once again, getting as much as I can out of that trade so that I don't suffer any cost once it goes against me. And I've trailed my stop to make sure that I don't suffer any consequences of pullbacks. And so at this point, I'm really at ease, and my psychology is very perfect. I don't think it gets any better than this. And so what I've done there is, when price traded up, you see that recent current price surge up there? I've now currently traded my stop loss to the high, because I believe that it's not going to go up there. It's set a new high. And so this really requires a lot of experience here. I don't expect you to be able to do this at your first trade. I think this requires a whole lot of experience to be able to trail your stop loss at a high that is so very current, that has literally just formed right now at this very moment. To be able to trail that and do that type of thing with full confidence that it's not going to stop you out, I think it requires a whole lot of experience. I don't think you could get that in a single day's work. You have to offer your own due diligence and do the back testing yourself and everything else that you need to do to be able to apply this concept very well and have an understanding, a very rudimentary understanding of these concepts. And so now I've trailed my stop loss literally to the previous high that we've had. So yeah. So again, those are the sell side relative equal lows that have just been taken out, and I've trailed my stop. I've taken out partials below those relative equal lows. And so I want to remind you again, relative equal lows are a way of what rests below relative equal lows is buy stops. Sell stops. So what retail does is they trail the stop losses below previous lows. When they are in long positions, they trail the stop loss below previous lows. And so what that does is it creates a ton of liquidity pool below the marketplace in the form of sell stops. And so at some point it has to get down and offset those lows. Do you understand that? I hope I'm not throwing you off here with the terms. And so yeah, that's the whole logic of sell side liquidity pools and relative equal lows. And so I think it's the easiest thing you could find on the chart and be able to determine literally relative equal lows. And so those are the easiest target points that you could target, And so what I've just graded right now is a sell side imbalance, sell side efficiency. Notice how price has traded above it. Same thing, a mohawk. It's given us a mohawk. It's taken out its high. So again, those are the imperfections of the marketplace. It's not gonna reject all of these PD arrays. The moment don't expect it. You see, every Tom, Dick, and Harry is gonna expect these PD arrays to work perfectly, without any imperfections. And so that's totally wrong. The markets are imperfect. They're gonna have some sort of fluctuations and go beyond their needs and boundaries. But again, the bodies is what tells the narrative. The bodies is what tells the stories. Notice how the bodies are staying inside of that subby, that bearish fair value gap, that red shaded area. Notice how the bodies are staying inside of the range. But the wicks, they go above that. The wicks do the damage. That's what does the damage. That's what takes out the dudes who trail the stop loss too early. Notice it takes out the high of that subby and it comes back inside of the range real fast. And so that was the whole logic of me setting my stop loss to the high, because I'm betting that it would not get up there. With full confidence, full high conviction, I know that it's not going to get up there because it's already showed its reluctance in its sell side delivery. In its buy side delivery. It's already showed its weakness to me. The fact that it gone up and it came back inside of the sell side imbalance, respecting it, because that's what it's doing. It's respecting the bearish fair value gap is respecting its original characteristics as a form of yielding lower prices, as a form of rejecting offer. And so that was the whole point of me trailing my stop loss to that previous high. It's not going to go up there. It's not. That's how these algorithms operate. And so I need you, it's very salient of you to understand that the market is imperfect. I need you to understand that, okay? The market is imperfect. It's not going to reject off your PD arrays. Perfectly. So yeah. And so those are the top things we call mohawks. So ICT likes, coming up with these terms. So he classifies that as mohawk. Those imperfections, those fluctuations, those damages that price does in the marketplace, the wicks, those are mohawks. And so again, I've taken a partial, squeezing the trade as much as I can to get something out of it, so that I don't suffer any, losses. And so right there, as it gets down to the regular trading previous settlement, as it closes down the entirety of that gap. Again, the regular trading previous settlement, excuse me for not telling you this, the regular trading previous settlement, the horizontal rate that I have shaded in purple, that's the 16:14 p.m. settlement price. So taking you back to that opening range gap that I was talking about earlier on, that's that low of that open range gap. So that's the previous settlement of Thursday's gap, of Thursday's close, of the regular trading hours session. So that's that previous settlement. And so as it gets down close to that previous settlement, I'm taking out partials. And I do eventually set a buy limit exactly at that regular trading previous settlement, squeezing again as much as I can out of that trade, squeezing the juice out of that trade, squeezing the lemon out of that trade. Yeah. And so boom, my buy limit is triggered. I've taken out partials once again, and I'm currently at one contract that's left. So at this point, I really don't have any worries. I could chill my stop loss if I'd like to literally the previous candle's high if I want. Squeeze again as much as I can out of this trade. I am emphasizing, the reason I'm emphasizing this is it's very salient that you take as much as you can out of the trade. Because what I've noticed with most traders is that they seem to think that price is gonna go straight to their TPs, their target profits, straight up without suffering any consequences of drawdowns, of pullbacks in the marketplace. Because again, the market is imperfect. It's going to have these periods of relaxations, of pullbacks in the form of, the relaxation is in the form of pullbacks. Excuse me for stumbling over my words. Okay, I do hope that you are following along with me. As again, English is not my first language. I do hope I'm trying my best to delineate myself and get as much as I can, get as much knowledge as I can out of me. So what was I saying again? I'm emphasizing on the concept of taking as much as you can out of the trade, squeezing the trade, because most traders seem not to understand that price is imperfect. It's going to have these periods of pullbacks. It's going to go against you. So you want to make sure it doesn't go against you to a point where it goes back to your stop loss that's about where you entered and stops you out, and you don't end up covering any wins on that trade. Because I think that's really demoralizing to not be able, to enter a trade, be in profit, significant profit, and then end up experiencing a pullback, and it ends up stopping you out without taking out any partials, any wins. And so that I think that's really, really salient that people take partials, you know? Yeah. So those are my fills. Those are my fills right there. Right there. You see how I got exactly at the high of that candle. Again, that's precision. That doesn't come in a day's work, guys. I want you to understand this. That type of, precision, that type of accuracy, that type of, you know, experience of being able to short exactly at the highs and get off at the lows. It comes with experience. It comes with hours and hours of tape reading. It comes with days experience. I mean, months and years of experience. Again, this is not my first year doing this. I've been doing this for the past 3 years. I've been doing this for the past 3 years, and I've been devoted for the past 3 years. I've been learning these concepts and applying them on chart. Mind you, what most retail traders make, what most novice traders, what they do is they just watch the videos with the expectations that they're gonna take as much as they can out of those videos and apply the concepts on their live accounts without practicing them on the demo, literally skipping the steps and procedures in order to attain this type of precision. And so with that type of fallacy, I mean, ill-taught type of individual, so you're never gonna get this type of accuracy that I get, being able to show these highs and get up exactly at the lows. Skipping those procedures and skipping those steps, you're not gonna get this type of procedure. You have to follow those things. You have to follow those things. I think it's very salient that people, yeah. I think I'm yapping a lot here. I'm doing too much. And so once again, that's an institutional order flow. Institutional order flow integral is when we had a SUBI, a bearish fair value gap, price traded into it, but it trades only just with a wick and doesn't close the entirety of that gap. And so we use that as signature of some sort of feedback that we are in the right side of the marketplace and that everything is good. Price is still real weak, very weak, significantly weak, and that's probably going to expel lower and exploit lower prices. Get down to those, those sell side liquidity pools where sell stops is resting below those lows. And so that's the reason why I trailed my stop loss above that institutional order flow entry. So that's where I've just trailed my stop loss right now. And so for spoiler alert, I do get stopped out above that high. And so I do take that as a signature of prices. It's reluctant in its sell side delivery, and at this point it's not so weak as I thought it was. And yeah, so I sat on the sidelines. I got stopped out, and I sat on the sidelines and I called it a day because I've literally grabbed, I think, 165 points on this trade. And so that's way more than I need. That's way more than I target a day, because all I need is that 5 handles. If I can get that 5 handles a day, I'm fine with that. I'm content with that. Anything above that 5 handles, I believe that it's a bonus point. It's a bonus point for me, because that's way more than I've targeted for the day. So I literally grabbed 165 handles. That's way more than anybody else makes in a day. That's way more than any of these retail traders make, with little to no drawdown. That comes with experience, folks. It doesn't come in a day's work. That doesn't come overnight. And so it's at this moment that price starts me out. It's at this moment that it reverses and pulls back and takes me out. And so yeah, without further ado, so that was it. That was the trade. And so I've graded the consequent encroachment of that previous candle's the premium wick. And so the whole logic is that if it closes above that 0.5, that 50% level, that midpoint, that consequent encroachment, because that's what it is, a midpoint of a premium wick is consequent encroachment. If it closes above that, it's obvious that price is weak, and it's feedback to me that it's probably going to stop me out. The moment it closes above that red line, it's feedback that I'm going to get stopped out, and it's probably strength. It's strong right now. It's probably trying to give us that pullback that we need, that moment of relaxation, as I said early on. Because the market is imperfect. It's gonna have these periods of pullbacks. And so yeah, so I do get stopped out right there. And so that was the trade of the day. That was Friday. So I literally grabbed 165 handles, way beyond that I ever target a day. I only target 35 handles a day. If I get 35 handles, I call it a day. Anything more than that, I mean, for Christ's sake, 165 handles, that's way more than I targeted. And so at this point, I'm done. I call it a day, and yeah, that was today's work. And so I do hope you learned something, and you found this video insightful, and you have extracted as much knowledge as you can, much concepts, and the understanding of how I use these concepts, the precision that comes with these concepts. Those are my executions. That's me sorting the high, experiencing little to no drawdown. Those are my partials. Those are my executions. That's the minus R side liquidity pools. Again, that's the relative equal lows where sell stops were resting below the marketplace, and that's me taking partials below those lows. And again, that's me taking partials again for contracts. That's that regular trading previous settlement price. That's me taking partials exactly at that regular trading previous settlement price. And that's me getting stopped out on the trail stop loss. And so yeah, that was it, guys. And I hope you learned something from that. And yeah, thank you for your time. And Lord willing, I'll see you next time.